So good afternoon, everyone. Thank you to those who have joined us. Thrilled for us to get started with our April webinar. Today we will be joined and led by Dr. Barbara O'Neill. I'll introduce her in a second. I just wanted to make a comment or two to all in the group. I know, actually looking at the list who's participating, this issue that I want to raise is probably well understood and the compliance is excellent, but I have a message that I want all in extension to hear and understand, and it's for the benefit of all of us, and in particular to make the lives of our county extension department heads a little bit simpler. And so my request to all of the faculty is that when you're planning programs that may involve the use of county facilities and or that requires some kind of county resources, space, vehicles, etc., please communicate with the CEDH well ahead of your scheduled activities so that he or she has the opportunity to plan appropriately. And in some cases, it may require communication with the county in order for us to meet our obligations and to make the program go more smoothly. And so with that, I don't want to take up much of Barbara's time. I don't know how well all of you online now know Barbara. She's been with us many years. Dr. Barbara O'Neill holds the rank of Distinguished Professor at Rutgers University. She's the Rutgers Cooperative Extension Specialist in Financial Resource Management. Dr. O'Neill provides national leadership for cooperative extension programs, Investing for Your Future, and Small Steps to Health and Wealth. She's a certified financial planner. Dr. O'Neill received her PhD in Family Financial Management from Virginia Tech and has written more than 1,700 consumer newspaper articles and more than 160 articles for professional publications. A well-deserved appointment as a distinguished professor here at Rutgers. She's also received more than 3 dozen awards for program excellence and over $1 million in external funding to support the financial education programs and research that she conducts. So it's my great pleasure to introduce to this body our distinguished professor, our own Barbara O'Neill. Barb.
Okay, thank you, Larry.
Is yours for the next hour.
Okay, and I'm going to present my desktop on my primary monitor, and hopefully everybody can see it. If not, let me know. It should say current issues in personal finance, income taxes, and identity theft. Okay, so these are two big issues that we faced, all of us as consumers, in the last year. We had the Equifax hack at the end of 2017, and then right before the new year, we had the passage of the new income tax law. So it just made kind of sense to focus in on those topics. And in case you didn't see my email, I did kind of piggyback on Larry's email before and sent you all the slides, a link to my slides in my SlideShare account. A lot of the slides have links built into them, and you may want to kind of consult additional information sources, so having those slides would be helpful. So
thank you, Barbara. I did receive
you can
that.
access those. Yeah. Okay, so moving right along. Presenting. Okay, I'm just having a little tech issue here. I'm going to see. Okay, there we go. It's not letting me advance this. Okay, here we go. So before we can understand the new income tax law, we really kind of have to have some background on income taxes. So there's all sorts of ways that we pay taxes in the United States. I kind of like to say programs that we kind of pay coming and going. We have taxes on purchases. So we're seeing that pretty vividly right now with the gas prices being as high as they are. So in those gas prices is built in a certain amount of excise tax. And if you remember, that was a big issue in New Jersey not too long ago. And then people who smoke also pay excise taxes that are built into the price of cigarettes. So we got taxes on purchases. We got taxes on property. So, of course, we know about real estate property taxes, paying a lot of them in New Jersey. Some states also have what they call personal property tax, where they actually have taxes on the value of their cars and things like that. There's taxes on wealth, so we've got federal estate tax and state inheritance tax, so that's the part where they kind of got you when you're going. And then taxes on our earnings, which of course is our income tax and Social Security tax. So lots of taxes that we pay. A little bit about the types of taxes. Some taxes are what they call progressive, which means that they take a larger percentage of your income as your income increases. So for example, federal income tax, as you'll see a little bit later, we've got different tax brackets, and there's a higher percentage as people's income rises. And then we've got regressive taxes that take a decreasing percentage of income as income increases. An example would be state sales tax. Everyone pays the same 7% in New Jersey. So obviously 7% of a person with, let's say, $250,000 of income is going to be much less of a hit to that person than somebody who's struggling trying to get by on let's say, $15,000 a year on income. So our marginal tax rate is the rate that we pay on the last dollar of income that we earn, our last dollar of earnings. So when they refer to tax rates, that's really what they're talking about. It's not that your entire income gets taxed at the rate, because there's different progression points as you go along, but it's the tax rate that you pay on your last dollar of earnings. And these tax rates, as we saw a couple months ago, are established by Congress. They can change periodically, and we had a major overhaul of federal income taxes with the Tax Cuts and Jobs Act, and we'll get into that a little later. Another piece of information that's helpful to understand is the difference between a tax credit and a tax deduction, because the tax law affected both of these. A tax credit is a dollar-for-dollar reduction of your income tax liability. So for example, if you have a $100 tax credit and you owe $1,000 of taxes, let's say, you would subtract $100 and then you would owe $900 in taxes. So it's a dollar-for-dollar reduction. A tax deduction, on the other hand, is the amount that your taxes are reduced by, which is based on your tax bracket. So you have to do a little bit of math. So for example, let's say you had a $5,000 tax deduction and you were in the new 22% marginal tax bracket. You do the math, that's $1,100 of savings, and then the rest of it, whatever that deduction is, maybe it was a charitable contribution, something like that, the rest of that would be out of pocket. That would be your net cost after receiving that tax benefit. So that's a critical thing to understand, because so much of the Tax Cuts and Jobs Act refers to itemization, tax deductibility, so it's just important to understand that your tax credit is a dollar-for-dollar reduction. Your tax deduction, the benefit is based on your marginal tax bracket. And if you don't know your bracket, don't worry. I'm going to share with you some resources later on, including a website we have at Rutgers that will tell you what tax bracket you're in. Okay, another piece of information that's really important to understand in order to understand the new tax law is what deductions there are that are available in tax law. So a deduction, just to define it first, is an amount that gets subtracted from your gross income, and it reduces the amount of your income that's subject to tax. And there's two types, and they've gotten a lot of attention in the last 6 months or so since the tax law really started to be talked about and then of course got passed. So the standard deduction is the amount that is established by the tax code as an amount that you can subtract from your gross income. And you don't need to itemize, you don't have to save receipts. You basically just have a dollar amount, and it's based on your tax filing status, whether you're a single person filing as a single individual or filing as a married couple filing jointly, and then you could also be married filing separate, and head of household. Those are our 4 different types of filing status categories. So it's based on that, and then age also comes into it because people who are 65 and older receive an additional amount for their standard deduction. But the bottom line is you don't need to save receipts. So as you will find out later, many more people are going to be able to take the standard deduction, which should make our tax record keeping a little bit easier going forward, at least for the 7 years that this tax law is in effect. And then we've got the itemized deductions. And then what these are defined by the IRS, subject to changes in tax law, as we just saw, and includes things like mortgage interest, charitable donations, property taxes. So there's specific things that we've spent money on during the course of a tax year that we are able to get a tax benefit for on our income tax. So again, I put some links into many of these slides if you want to follow up with additional information to read about them. Another important thing to kind of keep in mind as background is that itemizing is required when you make charitable gifts. So if you claim the standard deduction on your tax return, your gift is not going to provide you a tax benefit. That doesn't mean that there aren't any other benefits, because obviously your gift is benefiting the charity that you're donating to. So whether it's a nonprofit, whether it's 4-H, Rutgers Cooperative Extension, the Greater Rutgers University, or any other tax-qualified organization that you give money to, there are feelings of, you feel good when you give money to charity. But as far as a tax donation goes, you have to itemize. And up until the tax law was passed on December 22nd, about 30% of Americans were itemizing. So that means that, the majority of Americans, even before the new tax law, haven't been able to itemize, about 70%. So that doesn't mean that those 70% of Americans who couldn't itemize didn't make charitable contributions. Probably many of them did. They just weren't able to get any tax benefit for it. And now going forward, more people will be in that same situation. They're estimating that starting this year under the new tax law, only about 10% of taxpayers will be able to itemize. So that means that basically 90% of people can't get a tax benefit for making a charitable gift to an organization. So again, important to kind of keep in mind as we talk about the new tax law. The other thing that kind of came into the tax law discussion, because it concerned the child tax credit, is this whole concept of refundable and non-refundable tax credits. So a refundable tax credit is when you have a tax credit that's greater than the amount of tax that you owe. And if that happens, the IRS will actually send you additional money. You'll get that tax refund for that difference. So anybody that is receiving the earned income tax credit would be in this situation. And then there's non-refundable tax credits where you basically, if your credit puts you in a situation where you would be getting more money back than what you owe, you're not going to get any money. You're capped out. You can't save any more on a tax credit than the amount of tax that you owe. And a good example of that is people who receive the child and dependent care expenses credit. So people who pay a child care provider or somebody to assist with an older parent, for example, and have dependent care expenses, they would not be able to get any kind of refundable credit. Okay, and some other additional background is tax rate schedules and tables. So basically the schedules come into play when an individual or a couple filing jointly has a taxable income of $100,000 or more. So they have to use a schedule which requires some math computation to be able to determine what they owe. And then for anybody who is filing with an income of under $100,000, they basically look it up into the chart, which of course looks something like this. You've all seen it, I'm sure, where you basically have the income in increments going across on the rows, and then on the columns you've got those 4 different filing status categories that I mentioned: single, married filing jointly, filing separately, and head of household. And you just basically look up the number that intersects with the row for your income and the column for your filing status. Okay, and then some more background is tax withholding, and we've got the W-4 form, and some of you may have already taken a look at your W-4 form for this year and maybe made some adjustments to it. Back in the day, I remember at Rutgers, you used to have to go over to the personnel office in Martin Hall to be able to fill out your W-4 form. And now, basically, you can do it online at Rutgers. Just like everything else, you just go into the self-service part of the Rutgers website, and you can do that all online. So a little bit more about background with the W-4 form is that the decisions that you make for your W-4 form will affect your net pay. And I'm sure you've had this happen many times throughout your career. So if you choose 0 allowances, which is the maximum number, but you can go beyond 0, as you can see in the footnote in the slide, it's possible to have 0 plus $50 more. And you can do that as well. You can say, I want to have $50 in addition to 0 allowances if you think you have maybe extra income that you want to have withholding for. So it's possible to do that. So what happens then, of course, is you have smaller take-home pay and you have a larger tax refund. The reverse, of course, is if you have more allowances, 1, 2, 3, 4, depending on what you're allowing for, whether it's family members or itemized deductions or whatever, then you would have less taxes withheld, larger take-home pay, but because you're getting more income in your take-home pay, you're likely to have a smaller tax refund, or in some cases you might actually have to cut a check on April 15th as well. So the W-4 decision is really important, and we'll revisit that when we start talking about the aftermath of the tax law. So just some general strategies as you're tax planning, and many people took advantage of these strategies at the end of last year when they knew that the tax law had passed. You might have been among the people in New Jersey, and there were many people who did it, myself included, who prepaid our billed property taxes. It wasn't like you could just prepay any dollar amount. They finally clarified very close to the new year that you could prepay property taxes that were already billed in 2017, where you had gotten coupons and you knew exactly what that amount was. So many people did that. They accelerated their deductions into 2017 because they thought they would get a higher tax rate benefit than they would with all the changes with the new tax law. So people can sometimes do that with their planning. Yeah, so it kind of depends on what you expect. If you expect the same or a lower tax rate the following year, people will often accelerate their deductions into the current year where they get a greater tax benefit. On the other hand, if you kind of expect the same tax rate next year, people will often delay income if they can, just because they're delaying paying taxes, which is usually preferable to do. And then on the other hand, if people are expecting a higher tax rate in the next year, they might delay some of their deductions to the next year to be able to get a greater tax benefit. And they might also be able to accelerate some income going forward if they can. Obviously, people who have businesses have a lot more flexibility. So I mentioned this for some of you who are working with business owners, with farmers, for example, who have a lot more flexibility in the timing of their income than people with a paycheck would do. Okay, another piece of background information, we've got two more slides of background information, and then we'll get into the tax law itself, is the alternative minimum tax. And I've talked to a number of colleagues at Rutgers, both within SEBS and RCE, and I've heard many tales of woe from my Rutgers colleagues who have been affected by the alternative minimum tax. So this is a tax that's paid by taxpayers who have certain amounts of deductions of various types of income. For example, a high capital gain can trigger it, even a capital gain that you have no control over. For example, if you have mutual funds and the mutual funds just decide to distribute a high capital gain, that gain gets prorated through all the shareholders in that mutual fund, and then you get a 1099 form that indicates the amount that you have to add to your taxable income. Sometimes something like that is enough to put people over the limits for the alternative minimum tax. So this tax came about in the 1970s, I believe. There was a picture on the cover of Money magazine of all these high, rich folks. They were kind of like standing around a Rolls Royce with pearls and jewelry draping off of them and everything. And of course it caught the attention of policymakers, and the alternative minimum tax was put into effect because the article is basically flaunting the fact that they weren't paying any tax. But what's happened since the 1970s is that the AMT has increasingly been affecting people who are much less affluent than those people who were profiled on the cover of Money magazine, and particularly in high tax states. So New Jersey has the distinction not only of having the highest auto insurance rates, the highest property taxes, the highest percentage of young adults 18 to 34 living at home with their parents, but we also have the highest percentage of our population having paid the alternative minimum tax. So not something to brag about, but it's unfortunately a reality for people in the state. So again, it's something that a lot of people had to live with, and it was also addressed in the new tax law. And then finally, the last thing, just as background, is the difference between avoidance and evasion when it comes to taxes. I usually spend some time in my personal finance class talking about famous tax evaders. Students seem to like that. So tax avoidance, also known as tax minimization, is taking advantage of all the legitimate things that are available in tax law to reduce your tax obligations. So you pay no more than you owe by taking advantage of deductions, credits, tax deferral, tax-free investing, things of that sort. Tax evasion, of course, is illegally not paying the taxes that you owe. For example, people who overstate their deductions, don't report all their income, and things of that sort. Okay, so we've got lots of background that we've covered here. I can't actually see the chat here, so I'm just wondering if there are any questions. If there are, maybe Aaron, you can let me know. Otherwise, we'll delve right into the Tax Cuts and Jobs Act. So, okay, not hearing anything. So this was the law that was passed on December 22nd, and it was kind of a confusing process because you had the Senate bill and you had the House of Representatives bill, and each bill had slightly different things. And then finally, they had a conference committee, they got it all together, and it was signed on December 22nd, 2017. Sources that I've read have said that this law will impact individuals and businesses on a scale that hasn't been seen in over 30 years. So we basically have to go back to a tax bill that was signed in 1983 by President Reagan to have a tax law that's had such an effect and such an impact on so many people, just because of, it was just so comprehensive, all the different things that were included in it. Okay, so what I'm going to do is I'm going to go through, I think I have 6 slides that will just talk about the major provisions of the new Tax Cuts and Jobs Act, and then from there I'm going to include some slides that talk about implications on our work in Rutgers Cooperative Extension as employees, how we can deal with some of these changes. And then finally, I'll finish up with some resources that you can consult for additional information. So the first thing to know about this law is that it's not permanent. Not that any tax law is permanent, because tax laws can always be changed by passing new tax laws. But this one in particular has an 8-year period, and they had to do this because of provisions in the budget process where you can't have a deficit that goes over certain amounts. So they had to kind of project and say, okay, well, we know that we can do this for at least 8 years. So the time that this tax law is taking effect is 2018, starting this year, going through the end of 2025. And so we have 7 temporary tax rate brackets, and they range from 10 to 37%. And I have a slide coming next that will show you where they break out with various types of income. They've also eliminated personal exemptions for the next 7 years, that same time period. So in the past, you had various dollar amounts. I think the last one was $4,100, something like that, for every dependent that was named on a tax return. That's been eliminated for these 7 years. And then what they did is they nearly doubled the standard deduction. So remember, the standard deduction is that flat amount where they just tell you what to write off. You don't need to show dollar amounts. You don't have to prove it with receipts. So the standard deduction has increased to $12,000 for singles and $24,000 for married couples filing jointly. So because of this, that's where we're getting those projections now that I mentioned, where they're estimating that about 10% of taxpayers will be able to benefit from itemized deductions going forward, because the standard deduction is just so much higher than it had been that obviously you're going to go for the higher of the two, and for many more people the standard deduction is going to be higher than what their itemized deductions would be. Okay, so this is what the tax brackets look like as a comparison between 2017 and 2018. So you can see that in both years, the 10 and the 15% rate, well, the 10% rate is the same, and then we start to diverge. So the old 15 goes to 12, 25 goes to 22, 28 to 24, 33 to 32. 35 stays the same, and then they lowered the top bracket from 39.6% to 37%. And also note that the ranges of income are different than they had been too. I mean, they were scheduled to go up a little bit for indexing for inflation, but then they started tinkering with the tax brackets, and so they're different. So you've got the income ranges that are different than they would have been, and then you also have the tax rates themselves. And again, remember, the tax rate is the rate that you pay on the last increment of income according to these different brackets. Okay, number 2 slide about the law. The one that's, of course, been very controversial in high tax states like ours is the $10,000 cap for state and local tax deductions. So they use the acronym SALT for state and local tax. So this includes the state income tax, municipal property tax. Also, we've always had the ability as New Jersey taxpayers to write off a few other state-specific taxes, state unemployment tax, state disability tax, which show on your paycheck as SUI and TDI. Those are all gone too. So anybody who does itemize, who still can benefit from itemizing, and basically the only people who are going to be able to itemize now are people who have very large mortgages, very large unreimbursed health care expenses, which is not exactly a situation you want to be in, and then maybe people who make very large charitable contributions. Those people are probably about it as far as who's going to be able to itemize. Otherwise, you know, again, particularly with this cap in place, it's going to limit a lot of people, $10,000. And it's also not indexed for inflation. So most things in tax law get an indexing. This is going to be just $10,000 every year. So obviously, as prices go up, it's going to be a devalued amount for a lot of people. They've also repealed all the miscellaneous deductions that were previously subject to the 2% of adjusted gross income floor. So this includes things that affect all of us in RCE personally. If you belong to the union, those union dues. People who had uniform expenses, as some people who work at Rutgers, staff people, have to wear uniforms, people in maintenance, things like that, perhaps. Unreimbursed business expenses, tax preparation fees. I can remember when I worked in Sussex County that the county set the tax, the mileage reimbursement, and it was often very much less than what the IRS rate was. At least now at Rutgers, working at Rutgers kind of keeps up with the IRS rate, but many people had unreimbursed travel, for example. Tax preparation fees, all of those things that were miscellaneous deductions, which again includes all your business travel as well, those things have all been repealed. So there's just no write-off, zilch, nada, gone. And then the other thing that they did do, and this came as a result of Senator Rubio down in Florida reacting to the fact that the exemptions were taken away. I mentioned that previously. They did enhance the child tax credit. So it's going to be, again, for these 7 years, $2,000 per qualifying child. And $1,400 of that credit is refundable. So again, going back to the definition of refundable, that if the tax credit should get you to a point where it's greater than the amount of tax that you owe, you would still get up to the $1,400. So this is kind of a new twist in the tax law. Okay, slide 3. Lower medical expenses deduction threshold. I'm not sure why they did this, but they actually even made it retroactive to 2017. So it had been 7.5% of adjusted gross income for a number of years. Then it got raised to 10% of adjusted gross income. And of course, these are medical expenses that are unreimbursed, that people are paying out of pocket. And then they lowered it for 2 years back down to 7.5%. But big but, keep in mind too that for your New Jersey tax, the floor is only 2% of adjusted gross income. I don't know about you, but with the amount that we're paying for out of pocket from our paychecks for premiums now, that alone will hit the 2% floor. So save all your receipts, even though you can't maybe benefit on the federal level, because 7.5% of adjusted gross income can be a high hurdle for unreimbursed expenses. You probably can benefit in New Jersey. So I save all my receipts. And then, of course, your final paycheck of the year will tell you what your total deductions were out of your pay for the prescription drug, for the dental plan, and then, of course, for the health insurance plan as well. So save all those receipts. They did retain the alternative minimum tax for individuals, but 2 things have happened. There's going to be a higher exemption amount for the years 2018 to 2025. And then also, the AMT basically limited you to the ability to claim state income tax and property tax. But since a lot of people aren't going to be itemizing these deductions anyway, because the standard deduction is now going to be higher, many fewer people are going to be affected by the alternative minimum tax. So it's still there, and it's always a good idea when you're filing your taxes to run the numbers through the alternative minimum tax assistant on the IRS website, just to make sure that you don't have to fill out that form, because it's kind of a bear to fill out if you have to do it. But fewer people are going to be affected by that. Also, they changed the law that said that 529 college savings plan distributions can now be used for private elementary and secondary school expenses and even homeschooling expenses. There's a limit there, but this is the first time that now, at least for this period of time, that the law is in effect, can be used for expenses other than college. We've always had that with another plan called the Coverdell Education Savings Account, but now it's also available to 529 plans. Obviously, though, if you're using the money for secondary school or primary school, it's less money for college, so obviously there's trade-off there. Okay, what else happened? Well, they took away, if you had a home equity loan and you were, you have interest obviously on that loan and you were deducting that interest, that's gone too. And there was no grandfathering for anybody who had existing home equity loans. So sorry, no interest is able to be deducted on those loans. They also, and I don't know how many people this affects, because again, we're talking about people who have some pretty pricey homes here, but the limit had been $1 million of debt for tax-deductible mortgage interest, and that was lowered to $750,000. I can only imagine what the monthly payment would be on a mortgage of that size. But anyway, some people probably do have that type of payment. And then the other thing that they did is they're using a new version of the Consumer Price Index called Chain CPI to index dollar amounts in tax law going forward. And this is going to result in lower inflation adjustments than the previous Consumer Price Index metric that they were using. So this is going to affect all the things that get changed every year. For example, the amounts of income that fall in, the ranges of income that fall into the different tax brackets that we talked about before. Okay, moving expense deduction was suspended. So anybody who was planning to move for any reason that would have been qualified in the past, changing jobs, for example. I mean, you always had to move at least 50 miles. It wasn't like going across the street or anything like that. But that's completely suspended during the period of time, except for service members. So if there's any service members who's doing what they call a PCS, permanent change of station, their moving and storage expenses would be able to be deducted. They raised the estate tax exclusion, so that is now $11.2 million for an individual, $22.4 million for married couples if they do proper estate tax planning, which involves a process called portability, where the exclusion is transferred from one spouse who is deceased to another. That is going to be raised during this period of time. I mention this not because many of us probably have estates that are in this range, but again, some of you listening may be working with farmers who may have estates when you value their property and their land and everything else that's part and parcel of their farm. Could be people that might be affected. But of course, this is the federal estate tax. New Jersey, of course, is another story. And then finally, we've got student loan interest deduction up to $2,500 and remains unchanged. I mentioned this on the slide because there was a lot of discussion that all the student loan things were going to go away. And indeed, I believe it was the House bill was going to take away all the benefits related to student loan interest. But in the conference committee, this was saved. So the student loan deduction is available for the interest, and also the education tax credits remain. So for any of you who are paying student loans, that of course is good news. The Tax Cuts and Jobs Act also affected the Affordable Care Act. Not so much for us at Rutgers because we have obviously employer health insurance, although you might have noticed this year that you received an extra piece of paper that Rutgers had to mail us that was basically proof that we had health insurance in force during the calendar year of 2017. But in case you know people who are in the Affordable Care Act, maybe they're buying their health insurance through the marketplace for the federal marketplace. New Jersey doesn't have its own healthcare exchange. We use the federal marketplace. The fee that people have to pay if they don't have health insurance, which the IRS calls it the shared responsibility payment. That's the technical term that they use. That is in effect for this year. And it will become zero in 2019. So, in other words, they couldn't repeal the Affordable Care Act per se, but what they've done is they've taken a lot of the teeth out of it by basically the fee will go away, but that only starts next year. So anybody this year who doesn't have health insurance through an employer, through the individual private market, through the marketplace, healthcare.gov, whatever, would still have to pay the shared responsibility payment. Okay, here's another one that's kind of interesting, may touch a nerve somewhere. Alimony is no longer deductible by spouses who pay it or taxable to the recipient spouses who receive it for divorce decrees that are signed after the end of this year. So I've been reading all the financial planning magazines, and let's just say this is a banner year for lawyers who are in the family field, you know, those who are mitigating divorces, and also for financial planners who are working with clients around divorce. And you might wonder how this one came about. Actually, what they've realized is that the higher earning spouses who were deducting what they were, you know, paying their spouses, the lower paid spouses, there was more benefit to the payers, and the government was getting less income from the recipients who were having to include the income in their taxable income, so that they just decided to get rid of the divorce completely and not make it part of tax law while this law is in effect. Also, uninsured casualty losses can only be deductible if they are attributable to a federally declared disaster. And of course, they have to exceed 10% of adjusted gross income. They've always had to do that. So if your house burns down, you are out of luck. However, if there's a flood and the president declares a natural disaster, then you would be included. So, you know, it speaks to the importance, of course, of having good homeowners insurance, because now there's no tax benefit at all if anything of a catastrophic nature should happen to you. And in case you haven't realized it or read it, there's been some analysis done, and New Jersey has been hit harder than any other state from this tax law. Okay, so what do? Well, the first thing to do is to look at your tax withholding. I've put on the slide a number of calculators. The Wall Street Journal also has a really good one, but you have to be a subscriber in order to use their calculator. You know, there's paywall now that pops up when you use it. But these are some good ones that I found. And what I would do is do 3 calculators. I'm a firm believer in the rule of 3. You know, if you're going to hire a plumber, you check 3 plumbers. If you're going to buy something major, you check 3 products. So check 3 calculators. And what you want to do is have these calculators tell you the expected impact of the new tax law on your finances. And so I did 3 of them myself, and I found a range between $2,800 to $3,400 to the good. I was surprised, you know, but they're actually telling me that, you know, I'm going to come out ahead on this deal. So I did the 3 calculators. Then what you want to do is, hopefully you've saved your pay stubs if you print them out, or you can always go back online to self-service, and look at the difference between your net pay from the first paycheck that we had in January and then the second paycheck, which was January 26th, where Rutgers started to change your tax withholding to comply with the new tax law. So in my personal example, I got a $140 pay raise. I mean, it was the easiest pay raise I ever had. I didn't have to get merit pay, didn't have to do anything. Just got my $140. So what I did is, then what you want to do is take that difference. So in my case, it was $140 to the good. Multiply that by 25, because we had 25 remaining paychecks after that second paycheck in January, and then compare the two numbers. And that's exactly what I did. And so, you know, $140 times 25 was pretty close to what the calculators were telling me. So I pretty much have done nothing. Just basically thinking that it's all going to come out in the wash, that the change in my tax withholding is pretty close to what the tax benefit would be. I've talked to others of you, and I know it's not as pleasant a story. And I've talked to some people who've told me that their tax accountants pretty much told them that they have to take extra tax out throughout the year. But the best thing to do is to do the math that way. There's also a new W-4 tax calculator that the IRS has put online, and you may want to use that one as well. But do some analysis, and there's still plenty of time. I mean, we're only going to be 4 months into the year. There's still 8 months in the year to adjust your tax withholding. So it's not, you know, it's spread out over more paychecks. It's not just going to be something you do at the end of the year. So what do you do about the SALT cap? Well, some strategies you might consider are downsizing to a smaller home in your current town. Obviously, you would have lower property taxes. Maybe some people are thinking about doing that. Just maybe the kids have moved out of the house, and it might be a good time for your stage in the life cycle to think about that anyway. You might consider moving to another town that has lower property taxes. Sometimes it just means going over a border. So the difference between Mercer County, New Jersey, and going over the border to Morrisville, Pennsylvania, could be a big difference in property taxes. We sometimes see this up in Sussex County where I live. You know, we're right on the border of Pennsylvania as well. And many people in Sussex County live Dingman's Ferry, Pennsylvania, somewhere like that. I'll be selling a house in Sussex County in another year or so. So if anybody wants to buy my house, look me up. I pay about a third of the property taxes in Sussex County than some of my colleagues who work in the higher end suburbs of New Brunswick are paying. So just saying. And then the other thing is just to resign yourself to possibly paying more federal income tax, at least during this period of time that the law is in effect. But every situation is different. So in my case, I think the reason why the calculators told me that I would be around $3,000 to the good is that my husband is over 65. I just hit the big 6.5. So that gives us that extra standard deduction that I was talking about before. And then also our tax rate was lowered from 25% to 22%. So I think the combination of those things made the difference for us. But every situation will be different. So what do you do about the loss of the business expense deductions? Well, maybe now you have some expenses and you'll need to build them into program registration fees, you know, for travel expenses or something like that. Obviously, it has to be related to the program. Or maybe into grants or foundation gifts if you're having expenses to deliver programs or conduct research. Maybe try to build up your sundry account balance, honoraria, speaking fees, whatever, to pay expenses, again, that would be related to programs that might be non-deductible. Maybe just say no to actions that require unreimbursed non-deductible expenses. You know, with all the technology that we have, like this webinar today, maybe just hold a teleconference instead of having to drive to New Brunswick. Possibly consistent with RCE policies, of course, maybe do some consulting and then have that consulting income be the income that you can deduct expenses against. For example, things like professional dues. And then I guess the last one is just to kind of suck it up and pay these expenses out of pocket because you won't be able to get the tax write-off. And unfortunately, that's the reality for some people. So what do you do about the loss of the charitable contribution deduction? Well, there's four things that you can do. One strategy is the make yourself home strategy. So what that means is that you give what you used to give out of pocket when you used to be able to take tax deductions, now that you can no longer itemize. Simple example. Let's say you used to give $4,000 a year throughout the course of the year to various charities, maybe Rutgers, some other places. Okay, so you have $4,000 that you gave out of pocket. And let's say you were in the 25% tax bracket. So again, doing that math, you would have gotten a $1,000 tax benefit, so your out of pocket would have been $3,000. So with the make yourself whole strategy, you give $3,000 because that's what you would have given out of pocket anyway had you gotten the tax deductions. And with that strategy, I would suggest that you do one other thing, and that's to make yourself a charitable contribution budget. And just make a list. Go back through your tax returns and all your itemized, your documentation for your past tax receipts. Make a list of who you still want to give money to, and then have a other category to make part of your charity budget to be other, because you're always going to have some natural disaster, some friend who's doing a bike-a-thon where you're going to have last-minute contributions. So just build them into your budget. The other thing that you can do is donate appreciated assets instead of cash. By doing that, you avoid capital gains taxes, and most charities are more than happy to accept stock, and then they obviously would convert that into a cash asset. People who are over 70 and a half can donate from their IRAs so that their required minimum distribution doesn't have to count as income for their tax calculations. And then the other thing that more and more people are doing is they're going to bunch their donation funds into target years. So a target year might be a year that you expect to have a big increase in income. Maybe you're going to take a capital gain, for example, to use that money for some financial goal of yours that you've been saving for a number of years. So that's your target year. And what you might want to do is make a big charitable contribution in that year and put it into something called a donor advised fund. All the mutual fund companies have them now, Vanguard, Fidelity, and whatever. It's a special type of fund that you set up. You put a whole bunch of money into it during that target year, and then you write checks off the donor advised fund every year. So you're not making your charity say, okay, Rutgers, I can't give you money for another 7 years because I don't have another target year. You fund the donor advised fund in the target year, but you make charitable contributions every year. So many people are thinking about that. Okay, just finally to finish up some tax resources for additional information. Again, to know your tax rates, we have this website at Rutgers. There's all sorts of resources that came out. Iowa State University had a really good piece that also dealt with farm families. And then finally, I just want to mention the Equifax hack. So we had 145.5 million Americans that had their personal information exposed. Basically, it was the holy grail of personal information. They got everything. They got names, social security numbers, birth dates, addresses, credit card numbers, driver's license numbers. So the crown jewels, so to speak. And then, of course, if you remember at that time, it was very confusing. Phone lines were jammed when people were trying to, check out whether they were a victim or not, and the websites were frozen, and it was just a very confusing time for a lot of people. The CEO eventually got forced out. The senior executives who sold all the shares were exonerated. There was a lot of public discussion of alternatives for Social Security numbers to establish identity. And in fact, they are doing that right now with Medicare. In fact, this month they started rolling out the Medicare cards that are using random digits as opposed to Social Security numbers, and consumers were told to be vigilant. So my final two slides are just all sorts of ways that people can be vigilant. And I wrote a blog post about this, and you can access the blog post for additional information. But basically, it's just paying attention to things. And if you can set these things up automatically, that's even better, because it's hard to be vigilant all the time. Vigilant, by definition, is a state of heightened awareness. And people can't be heightenedly aware all the time. We just aren't. So if you can set these things up automatically, trigger yourself, write it on a calendar, that this is the time to check my credit report. I recommend checking your credit reports every 4 months. Check one of the big three so that you're reviewing a credit report on a more periodic basis. Check your credit statements, your bank account statements. Freeze your credit. I personally did that, so it took 8 times because I had to do four credit bureaus for myself, 4 for my husband, but we are totally frozen. Now anybody who would want to look at our credit to establish anything in our name, they're not going to be able to do that. There's some talk about making a credit freeze free nationwide, but it is free in New Jersey. It doesn't cost anything to freeze your credit. It does cost $5 when you have to lift the freeze. For example, if you're applying for a loan and need to lift it temporarily. These are just some other things. Monitoring your credit score. Just beware of phishing frauds too, because phishing is where you've got a scam that's very personalized. And now that these hackers, or whoever the hackers sold their information to, have all our information, they can make the pitches much more personalized because they know that much more about us. So just remember, if it sounds too good to be true, it probably is. Take advantage of any kind of free credit monitoring, which a lot of people did when the hacks were first announced. And then I personally just never let my credit cards out of sight. So I just pay cash at restaurants and at gasoline attendants, and don't have to give my card to anybody. It's just another layer of protection. But again, these are just some things to think about. You can read the blog post if you want to know more about that. And I think we're just at the top of the hour, so I'm going to turn it back to Larry in case you have any other questions. Great. Or Aaron, and we're good to go.
Thank you so much, Barbara. That was really jam-packed full of useful information. I do have one quick question about capital gains taxes. Mm-hmm. And I apologize if you did mention the rate on that. Is that still at a lower rate? But really, my question is, I'm writing the cap off the capital losses. The annual cap is still seems to me quite low. Is there any conversation, or has anything changed in the payout or the capital loss write-off?
No, that didn't change. So that you can still carry forward the losses, but there's the cap. Yeah, that didn't change at all.
And they carry forward forever, right?
Yep, keep carrying it. Yeah, it can take a while. Yeah, decades for some people. Yeah.
Good. Thank you. Anyone else? Usually we give a second in case people are typing in a text question. Don't see anything coming in. Oh, here we go. Good. So a comment from Elaine. Simplifying.
Yeah, absolutely, Lane. That's a really good point. The more that you can simplify, consolidating accounts, automatic payments, automatic debits, all of those things can be helpful because obviously there's less mail that can be stolen when you have paper statements, and yeah, so simplification can eliminate a lot of headaches for sure. Good point.
Thank you, Elaine. I think we are all set. Oh, okay. Here's one from Aaron. Should married couples file jointly or separately?
Well, in most cases in the past and going forward, it will be a benefit to file jointly, because you'll get that $24,000 standard deduction. If it's a couple over 65, it's $26,600. There usually are very specific cases where you would file separately, and they're usually very limited. So, yeah, enjoy that larger standard deduction for sure.
So that Elaine is typing. Maybe she has another question.
Oh, it's $1,300 per person, Elaine. So again, if it's a couple with two people over 65, it would be 26,600. You would add another $2,600, $1,300 each. The privileges of getting older.
Great. Barbara, thank you so very much. Thank you to all the participants. And I think this was a great presentation. And I see as usually happens at the end of the webinar, the thank you notes start rolling in. So thank you. Thank you, everybody.
Okay.
Have a wonderful weekend, and we'll see you at Ag Field Day. Oh, I mean Rutgers Day. No, I really mean Ag Field Day.
Bye-bye.
Bye now.